Hello and welcome to the Life by Design podcast, brought to you by Strategic. This podcast is all about helping you live your great life. Each episode will feature insights from our Chief Investment Officer, Doug Walters. Hello and welcome back to the Life by Design podcast. I'm here again with Doug Walters, our CIO at Strategic.
Hey Jay, how are you doing?
Fantastic. So today we're going to do another little bit longer form with Doug. We're going to go through our weekly insights that Doug and team wrote from the previous week. And then we are going to dive into a topic that we've brought up multiple times. And I want to know more about it. And I'm sure you at home want to know as well. So, but to start us off, Doug, you kind of pointed out a lot of coincidences around the number 10 this week in Weekly Insights.
Right. Yeah, and it's one of those things when you're just searching for what to write about, what's interesting. And I like to look at the numbers in detail, and I noticed that we are up 10%. When I say up, the US stock market is up 10% from the recent bottom, and it is still 10% below the peak that we had in February. Mm-hmm. But all that said, when we look over the last year, so the last 12 months, stock market is up 10%. So just this coincidence of tens came out in the numbers.
Yeah. When you brought that out, and I was thinking about it too, is that it's interesting because when those correlated, those numbers correlate like that, sometimes in my brain, being someone that's not like highly intuitive with math, is that if it goes down 10% and then comes back up 10%, those aren't equal numbers.
That's right.
Because the total changed, right?
Exactly.
So I was like very much contemplating that and like trying to swim through those waters of 10% changes and go, well, I don't know what any of that actually puts us at.
Yeah. If the market goes down for 10% and then goes up 10%, you're still below where you started.
Right.
But yeah, the big picture, not in those 10% numbers, is, from the peak to the trough, we were down about 20%. And that's where, we've climbed roughly halfway up from that 20%, which is why we are, 10% up from the bottom and roughly 10% down from the peak still.
Okay.
Yeah.
Yeah. So just for those at home, if you were wondering too, that was one of my big questions. And so I think part of that comes in, and this is going to go into our bigger conversation, is with those kind of lows is diversification, right? And knowing that you're diversified during these times actually is going to help offset some of this volatility.
Right. Yeah. And if you have a well-diversified portfolio, you might be pleasantly surprised to look at your balance and realize you may actually not be down on the year. A lot of our strategies are actually up on the year because of that diversification.
Right. And I know it's one that we've brought up multiple times, but with like the S&P still being down like a little bit over 6%, gold is up 25%.
Right.
And that's one of those balancing acts that we're doing.
Right. Yeah. And international is up significantly relative to the US as well. So there's multiple pieces of that diversified portfolio that have actually done well so far this year.
Yeah. And I think it's something we've said multiple times, but worth saying again, that you're not trying to tell the future. You're just trying to be prepared for it.
Right. Exactly. We didn't predict that gold was going to continue to outperform. It was still screening positively on our the screens that we do. It's why it's in the portfolio, but it wasn't a prediction. It's just a part of a well-diversified portfolio.
Okay. And so before we get into our main topic, is there any kind of things coming up in the next week or stuff that we're going to be keeping an eye on, or that anybody should be be aware of?
Right. Yeah. And we've, this week we've seen the continuation so far of the rally that we ended on last week. And that's come as a result of some, lightening up on the tariff discussions. I think there's still a lot to be determined on that front, but we've seen anyway some loosening of those tough tariff talk, and so that's helped. And then tomorrow we have an inflation number coming out. PCE inflation is the one the Fed tends to spend the most time looking at, and is one of the most relevant economic pieces of economic data that comes out. So we'll be looking at that tomorrow, and probably by the time this podcast comes out, it'll be yesterday. It'll already be out. Yes.
Okay. And so now getting into our main topic, and this is, for our listeners at home, this is something for me to understand as well as I speak with Doug and the team. And one of the big topics that always comes up that I realized maybe I didn't know enough about was portfolio rebalancing and what exactly it is.
Right. Yeah. So we'll get into that today. And, at a very high level, the purpose of portfolio rebalancing is to keep someone within the appropriate risk allocation, right? So we assign a risk allocation to our portfolio, and then we want to make sure that the client stays well within the range of that risk.
And so I guess when you say risk in regards to a client, what does that entail, and what does that mean?
Right. So for each client, we want to work with them to understand what is their sort of willingness to take risk, but also as advisors, what is their ability, and sometimes what is their need to take risk. They may need to take a little bit more risk than they're willing to take. So we're trying to balance that equation, and by risk we mean, what essentially, how comfortable are you with the ups and downs of your portfolio? The more risk you take, hopefully the more reward over time, but you're going to get more significant ups and downs. You can't get the higher returns without a little more volatility along the way. So we're trying to strike the right balance for each client based on, again, both their willingness and ability. And just to put a little more color on that, especially ability, someone who is relatively young, has a long investment horizon, has good stable income, they have the ability to take on a lot of risk. Whereas someone who maybe is living more on, say, a fixed income, has a shorter potential lifespan, perhaps, they maybe don't have the same ability to take risks. So we'd want them in a more conservative portfolio.
Okay. So it's not just what I want, it's also what I need,
right,
from a financial perspective, let's say towards retirement, right? So if, as an extreme example, if someone's maybe only X years out from retirement and they're closer than a 20 something, but they haven't, for whatever reason, haven't really been able to save for retirement, then they would almost have to take a higher risk in order to get the gains that they would need to do what they have to do for retirement.
Right. Yeah. We've, obviously would work with them to try to, minimize the expense side of the equation so they can, live that comfortable retirement, but they may need to be taking a little bit more risk in order to get them through retirement. Somebody who maybe has reached retirement very comfortably, has a nice nest egg, and just is like, I just don't want to ride the ups and downs of the market. They have the ability probably to take a lot of risk if they've got a big nest egg. They just don't have the willingness, and they don't have the need to. They can just, ride out the income of that portfolio the rest of their retirement.
Yeah. And so, the word risk is always like, kind of has a negative kind of, feel to it. And so like, I just wanted to understand that, because I was like, I know risk. So I hope for you at home that kind of explained it. So we look at that profile,
right?
That we just kind of walked through some examples, extreme examples on either end, but we walked through some examples of what a quote unquote risk profile would look like for a client or an investor. And then we apply what we call portfolio rebalancing to make sure that we're within that risk profile over time, right?
Correct. Right. Yeah. So, and there's different types of rebalancing that you can do, but the idea generally is over time, different assets are going to perform differently, and your risk allocation will change. So typically, let's talk, at
Yeah.
the most basic level, right? Stocks are more risky than bonds. Stocks tend to go up more over time than bonds. If you just leave it alone, you do nothing, stocks will become a bigger and bigger part of your portfolio. Your portfolio will become more and more risky, and that may not be in your best interest. We're going to want to rebalance and make sure that you stay within an appropriate risk allocation.
Okay. And so with that, like some examples could be that, if I'm at a higher risk, there is the potential upside that I could quote unquote, right, have this larger portfolio because I took the risks to do it. But I also could have a smaller portfolio because I took the risks and they didn't. And then if I just stay in that zone of high risk, high reward, it won't be as balanced towards the end.
Right. You're going to want to stay within an appropriate risk level for you. And I was trying to think, Jay, like, how can I put this in terms that Jay would really, would really resonate with him? And I was thinking of collectibles, and I don't know. You mentioned the other day you have a Star Wars collection.
Yes, yeah, I do. Yeah, just for everyone at home, I'm a super nerd, and so, yes.
And I'm imagining there's other collections as well. And so, let's say that Jay's like, I'm just going to tie up my entire net worth in my collections. Okay. And so you put, 25% in your Star Wars collection and 25% in, I don't know, you tell me, what else might these?
Magic the Gathering, right?
All right. So Magic the Gathering and 25% in two other, different collectible buckets. And you're like, I'm really comfortable with the long-term outlook of all four of these. And so I kind of want to own them in equal parts. And over time, they're going to perform right differently. The value of these collectibles are going to change in different amounts. So let's say Star Wars, right? So Star Wars over time is getting more and more popular the further away we get from the 1970s when some of these toys first came out. They just keep going up and they become very popular. And suddenly Star Wars is now 50% of the value of your net worth, right? 50% of it is tied up in Star Wars. Now that's risky, right? And so Jay has not been rebalancing, right? He has just been buying and holding. And so that's the risk. And let's imagine something happens, right? To the brand of Star Wars. George Lucas was, hiring child labor during the during the filming of Star Wars, and suddenly and suddenly Star Wars is paraphernalia is not worth anything, right? That was a huge risk. Now 50% of your portfolio is worthless. So that's the risk of not rebalancing at all.
Okay.
So that's not rebalancing. The sort of next step in rebalancing, sort of what a lot of firms out there are doing, very common, is what's called calendar-based rebalancing. Okay. And for this, continuing with our example, you're going to be pricing out the value of your collectibles every year. And every year you're going to look and say, all right, Star Wars has done much better than everything else. So I'm going to sell some of my Star Wars collectibles down to a level where it's equivalent to the others. I'm going to use those proceeds to buy some of the others. I still love all of these collectibles, right? Equally. I find, you have equal confidence, right? That they're all going to do well. They're all a good part of your portfolio. So you're going to sell some Star Wars and put it in some of the other collectibles. Okay. And that's calendar-based rebalancing. And it is good. It is value added, but it is not the best thing you can do for your rebalancing.
All right. So now, which would lead me into the next thing, which is the one we talk about a lot, is opportunistic rebalancing then.
Correct.
Okay.
Right. And so to take this analogy
even further.
Okay. So you've got your 4 equal buckets of collectibles.
Okay.
and you are not watching these once a year and not valuing them once a year, you're watching them every week.
Okay.
And you're not just watching, how is Star Wars doing, but you're looking at each individual piece that you own. And let's say, some news comes out that, we just realized that, this Luke Skywalker figurine had, there was some like manufacturing defect on some of them that we never knew before. Right. And Jay looks at his and realizes, I've got one of these. And suddenly this $100 figurine is worth $2,000.
Yeah.
And so Jay sees that because he's looking every week at these, and he's like, you know what? I'm going to sell this Luke Skywalker figurine for $2,000 and rebalance my portfolio. So opportunistic rebalance is looking every week at every asset you own to see if something jumps out of a normal band. Okay. So in this case, the Luke Skywalker figurine jumps out. You're like, all right, I need to sell that.
Yeah.
That is way too valuable, and then buy something else that is, hasn't performed. You're looking for your worst performer. Again, things you still believe in, things you think are going to work in the long term, just haven't materialized yet.
Right. Something like I know will hold its value, but it just hasn't jumped like the Luke Skywalker example did because of something that was found out.
Right.
Okay.
And if we kind of tie that into, say, the last couple weeks, right?
Yeah.
We have seen some significant moves in the market. And we saw a market that fell 20%, and then within a couple of days, let's say it fell 10%, and then within a week, so that week of March 31st, I think it was, market fell significantly. Stocks underperformed bonds by like 10% in a week. We were looking at that performance, identifying that stocks were suddenly much cheaper than they were a week ago. We had the opportunity to opportunistically rebalance, buy something or sell something that held its value, most likely gold, and then buy those stocks that underperformed. The next week, stocks outperformed bonds by 8%. We saw a huge reversal. So opportunistic rebalancing is never going to get that perfect, but it has the opportunity to catch those one-off moves. And, to put it in, back into the analogy, imagine that, you've sold your Luke Skywalker and then news comes out, that wasn't actually a manufacturing defect. They all have this thing, and your Luke Skywalker is back down to $100. You got rid of it for $2,000 because you were looking every week.
Okay. So that's great. That actually is perfect explanation for me. So a lot of that was explanation was in the first person of me doing this and looking at this. So for clients that utilize our services, that how do they see this rebalancing when they're looking as almost the third person view, right? Because we're doing that for them from a week to week basis or however often. And so how do they see it from their viewpoint? Right.
Yeah. So we are obviously doing that work on their behalf. We're looking at every account, every security to see if it has gone outside of what we call a rebalancing band. So when something does trigger, they're going to see, a sell of that outperforming asset and a corresponding buy of some underperforming assets. And so they will see trades in their account, right? And they might wonder, what was this? Was this tactical? A lot of times it is, more often than not, it's not tactical. It is simply rebalancing, systematically selling high and buying low. And we will get questions, right now, for example, our primary source of funds, meaning what we are selling, is gold, because gold is significantly outperforming everything else. And so they will see us selling gold in their portfolio and buying something cheaper, some cheaper equities that have underperformed. And we'll get the question, why are you selling gold? It's the best performer in my portfolio. And it's like, that's exactly why we're selling gold. We are locking in those gains for you.
Right.
We're cashing in on that expensive gold and buying something cheaper that we still believe will outperform over the long term.
Right. And I think that's the, what is that bias fallacy, that it's the winners fallacy, where they're going to keep winning, right?
Right.
And it's just, if I keep putting the money in the slot machine, I'm winning right now. So
Right.
if I keep reinvesting that into the slot machine, I'm going to keep on winning.
Right.
And it's at some point that stops being true, right? And
Right.
so what we're trying to do is just not predict that it's going to be true, but just say, hey, when we got into X, it was at this dollar amount. The Luke Skywalker, I maybe I bought it for $5 at the local swap meet, and now it's $2,000. That's the highest I've ever seen it.
Right.
And so I should take that money to put it into something else that I believe will perform in the future.
Right. Exactly.
And it could it could potentially go up to 3,000.
Could.
It also could go back to $5 or 100 in your
Right.
example. And so just kind of like weighing that and saying, okay, listen, we got, if I bought it for $5 and it sold for $2,000, I got $1,900 basically, roughly out of it, almost $2,000. So
Right.
now's a good time to reallocate that.
Right.
Okay.
There's a subtle point here, which is also worth making. We talk a lot about momentum. It is one of the factors that we invest in. And you might say that seems contradictory to rebalancing. Momentum is buying things that are going up.
Mm-hmm.
And we do that as part of our strategy. One of the factors that we buy is momentum. How opportunistic rebalancing factors that in is we set, when I talk about those trade corridors, those rebalance corridors, we set them very wide.
Mm.
We're not looking for something that is outperformed by 1%, 2%, 5%. We're looking for something that is outperformed by 20% relative to everything else. And that's a big barrier, especially if everything's kind of moving, to some degree together. It takes a lot to outperform by 20%. And so we're not going to sell something immediately just because it did well. It has to be a significant outlier on the upside before we trigger that rebalance. So we're taking advantage of that short-term momentum. Yeah. But at a point where it's gone too far, we want to take advantage of that.
Okay. All right. I think that all makes sense. Mm-hmm. So then I guess we just kind of wrapped up, well, for the most part, most people just wrapped up tax season, and we're heading into a new year. And so one of the questions I had, and I think comes up sometimes, is what are some of the tax implications around rebalancing, if there are any?
Sure. Yeah. If you are in a taxable account and we are rebalancing, we're selling something that is done well, there's likely going to be capital gains on that sale. And that is just a cost of keeping your risk in check. Because the alternative is to not take the gains and continue to let your portfolio get further and further away from that risk allocation. For some individuals, that might be the option they want to take, but you are taking significant risk. It is not out of the realm of possibility that equities can fall 50, 60%. Like that has happened in the past. So keeping your portfolio in check at the right risk allocation is really important. And we do encourage our clients to, take that tax hit in order to keep their portfolio at the right risk level.
So I guess to bring it back to my collectibles, if we use that Luke Skywalker as an example, let's say somebody offered me, if I went to sell it, somebody offered me like $2,300, but it was going to cost me $200 or $300 to ship it and prep it to get it out to them.
Right.
I'm still making, yes, I'm off of the sale, I'm losing $200 or $300 from the shipping and handling, but I'm still making all that money that I made to reinvest into other things that I didn't have before, because I only paid $5 for it or whatever.
Right. Yeah. You don't pay taxes on losses. Right. So by definition, if you're paying a tax, it's because you've had a gain.
Okay.
So, take that gain, enjoy that gain, pay the taxes that are necessary to keep you in the right risk profile.
Okay. Yeah. Well, that all makes a lot more sense to me. Yeah, I think unless you have anything else, Doug, I wonder if I don't know. Is there anything else you wanted to?
No.
That was a lot.
If,
So I'm
if
feeling
that,
pretty
yeah,
good.
If that makes sense to you,
Yeah.
then my job is done here.
Okay, great. Well, thanks, Doug, and I hope everyone at home that bringing it into the world of Jay helped maybe make it more palatable to you. So, if you guys have any questions, you can leave comments always on any of our videos or podcasts, and maybe if it's relatable, we can try to ask it on the podcast. So,
All right. Thanks, Jay.
thanks.
This podcast is for educational and informational purposes only. Please see the full disclosure in our show notes for more information.